Hello traders, Theo Nagpan here, founder of Master the Markets Elite Traders Conference and the Traders Open Day. So today's topic is going to be on how do you build a strategy. Now strategy is such a common word between so many thousands and thousands of traders, right? But one thing first, rather than you just running after strategy of the strategy and just picking it up from a web and just going and doing it and practicing on it, and trading it to see if it makes any money, and then if it doesn't, and then to wrap it up and then to go after another strategy, I think sometimes traders, it will be a good thing to just take a step back and really think about how do I actually build a profitable strategy that actually can be reproduced, can be scaled, and one that fits your personality, right? So it'll be very useful to do that, and that's what this video is all about. And I'm going to show you 3 points that you should consider when you're actually building a strategy. Right, so the first thing is what we call the concept, the concept. Now the concept of the strategy is the first thing that you need to be looking at before you even start to even putting the rules together for your strategy. Right, so let's take a look at some familiar concepts. I've actually mentioned in some other videos and the talks and conferences that I've done over the world as well, that some of the concepts will be swing trading is what we are looking at, right? So for example, swings, basically, in terms of a concept, comes from a point where it says price does not move in a linear fashion. Price does not move in a linear fashion. So it comes from the concept of this, of price does not move in a linear fashion, and then from there, we're getting into this thing called, into swings being formed in the market, and all of that, then you build strategies around that concept, around the swings, okay? So for example, so since we're saying price does not move in that, and therefore it will move in cycles, and then we're looking to capture those swing turning points from that concept. And it's a very strong concept, traders, because a strong concept is one that stands through time. Because when you can stand through time, that's when you know that it's going to keep reoccurring again and again and repeat itself. Therefore, you can then make money out of it recurringly, and you can also have an edge around it that would then put the confidence in you to keep on reproducing your profits, right? So that's a good concept. One more, I give you just one more example, right, of a strong concept as well, is basically price moves a certain amount, right? A certain X amount every day, right? So if you look at your daily bars, they move at least a certain amount every day. If they didn't, then you would just have a horizontal line in basically a chart, which we don't see that, right? So, and if it does that, I mean, you don't want to be trading that, of course, because it's not being really heavily traded, right? It's not very liquid. So you want, on a concept of it moves a certain amount of range every single day, is basically from that concept, then you can then go into your shorter time frames and look to capture that amount every day, or we can call that as range trading, okay? So that's a very strong concept as well, right? Because it will stand through time, and you will know that particular instrument has got to move that X amount every single day as well. One of the parameters that you can use, one of the tools that you can use, I'll come to that later on how you can actually define that from those concepts. But the first important point is that you have to have a concept before you even think any further down the line on building your strategy. And that concept, what has it got to do? It's got to give you a strong edge in the market, okay? And these concepts, when they are strong and they hold true time, will naturally give you that strong edge. The second point, traders, that you need to be really looking at before you build your strategy is your objective. So critical. I can't stress to you how important this thing is. And most traders are like, just trading even without even understanding this objective. This is where it all actually then has got to come into alignment with from this point. The second thing is, as I said, the objective, and you have to now get very, very clear on what is it that you actually want to capture from your strategy. How much move do you want to capture? Because you see, traders, if you don't have this defined, what then happens is the two emotions start to kick in, right? The greed and the fear. Because, especially greed, if you don't have an objective clearly stated and defined, when you actually exit from the price, exit from the trade move, and then the trade then shoots up another 200 pips, and you'll be like so gutted. You'll be like, oh man, I should have really stayed in there more longer. What should I do? You might then start to tamper with your rules, and then the next time around, when you then start to think, oh, it's going to go up more further, then it really retraces, hits your stop loss, and all that not, and so forth starts to happen. All those scenarios come to happen. So that's why for consistency, we need a very clearly defined objective, right? Okay, so now, in terms of the objective, what do we really need to get certain about is how much percentage of the move do you want to capture. For example, in swing trading traders, what we are really looking at in terms of, let's say you want to capture phase 1 of the move, which is in line with the trend, we are looking at maybe an objective of capturing 70% of that phase 1 move, okay? So let me just write it down. So 70% of the phase 1 move. If you're talking about range trading and kind of objective, let's say you can then relate it in terms of ADR, and that can be any X amount. It could be even 0.6 ATR that you're looking to capture every single day of that daily range move as well, right? So these are the things that you need to really clearly define before you then even step even into the market and consider even taking a trade, right? So concept, objective. Finally, once you've defined these two things, so critical even before you start to even put your rules in, then finally the third thing is then to choose your tools, right? Your tools to build your rules. Usually we have about 6 tools, and I have mentioned this in the other videos, and you can definitely go and watch them in our blog as well. Now, out of the 6 tools, what are we really looking to achieve? What are the most important things that you are looking to achieve when you formulate those rules from the 6 tools that you pick and choose from? Is that those rules must all be quantified. So important, traders. If you do not do this point, then the second component of your trading strategy being valid totally becomes redundant, which is actually consistent execution. Because without quantification, doubt creeps in, and when doubt creeps in, all kinds of emotions can flow in, right? The fear and the greed and all that kind of stuff, because it becomes subjective, right? So they must be quantified, very, very important. And actually in our Traders Toolbox, Trade Like a Master video series, we actually explain to you how you can actually quantify even those rules as well. What's the best litmus test for quantification? The final thing that you also do need to mention as well is your money management rules, okay? And especially the thing that you need to put into there is the things like, the usual stuff like risk management, like per trade, total portfolio, maximum drawdown kind of risk. You do need to mention all of that. And also, important thing that you need to consider as well in building a strategy is what's your reward to risk ratio going to be? Is it going to be like less than 1-to-1 kind of a trading strategy? Or is it going to be more than 1-to-1? Or is it going to be at least minimum 2-to-1? You have to all mention that as well. But do remember one critical thing that we want to say over here is that all this is expected reward to risk ratio. Then you got to then track and see how actually your strategy is performing, right? So these 6 tools that you then pick and choose is to at least form what we call 4 degrees of freedom, and that's usually about 3 entry rules what we are looking to formulate. At least 3 entry rules, 3 to 4 entry rules is what we are looking to formulate, right? So do consider these 3 important points over here. First is concept, second is objective, and finally tools that you pick and choose to then formulate a strategy which is in line with the concept and the objective of the strategy. By doing that, you will then be able to form a very strong strategy which has got a solid edge in the markets that can then help you produce consistent profits, traders. So traders, I believe this has been of immense, massive value to you. Very important. Do contemplate on it. Take a step back from your strategy and then look at the overall picture to formulate then your rules, okay? And then finally, you will build that strategy which reaps you the returns. Till the next time, as we always say, stay disciplined, follow your trading plan, and keep trading like a master.